Goodwill on admission of a new partner. When a sole trader who has been carrying on a successful business for some time, or an existing partnership firm admits a new partner either for introduction of additional capital or influence and the consequent extension of business, or for the purpose of bringing exceptional skill or fresh energy into the business, the newcomer is required to pay some premium to compensate the existing owner or owners of the business for the surrender of a part of the profits which he or they have been hitherto enjoying in full. Such compensation or premium paid by an incoming partner on taking a share in an established firm is called goodwill and is quite distinct from any amount that he may have agreed to bring in as capital. Goodwill may thus be looked upon as a compensation paid by a newcomer in an established business to the existing proprietors thereof for their past efforts and the risk of capital they underwent to bring the business in its present stage of reputation and profit-earning capacity, and in return for their agreeing to forego a share of future profits for his benefit. It must clearly be understood, however, that goodwill only attaches itself to a business which has been yielding super profits, i.e., more than average profits returned by other businesses in the same line of trade, in the past and where there is a reasonable likelihood of equally profitable conditions being maintained in the future. In fact, it is a payment made by the newcomer in the hope and the chance that the benefit arising from the reputation and connections already formed will continue in the future, and that whereas he would be taking a share in the profits from a ready-made business for which the old proprietors labored in the past, he would save himself the risk of capital and the trouble and anxiety he would have had to undergo if he were to start a new business on his own. Goodwill is always a partnership property and it goes with the business. Evidently, therefore, the sum received on account of goodwill from a newcomer would belong to the existing partners in their profit-sharing proportions and it would be credited to the respective capital accounts. Whether the amount received by way of goodwill should be withdrawn by the old partners or whether the same would be retained in business as an additional working capital is a matter of agreement between the existing proprietors and the newcomer. It is important to note that a new partner enters a firm. He acquires by virtue of his position two rights: A, the right to share in the assets of the partnership, and B, the right to participate in the division of the profits. Thus once a person is admitted into partnership he becomes entitled to share in all profits and gains arising from the date of his entry irrespective of whether such profits accrue from the trade or from an amount realized on the sale of an asset in excess of its book value or from the sale of an asset which does not so far appear in the books, unless such newcomer is precluded from taking a share arising from any particular source by express agreement. Thus if after admission of a partner the goodwill of a firm is realized, the newcomer along with the other partners will be entitled to claim his share thereof, unless it can be shown that under an express arrangement he was not to share in such profits, and it will be no answer for this purpose to say that he paid nothing for his share of goodwill at the time he entered the partnership. If it is desired that he should have no interest in the firm's goodwill, it is perfectly competent for all the partners to make an agreement upon the admission of a partner that the latter should have no interest in the firm's goodwill. Different methods of dealing with goodwill. The method of treating goodwill in the books of accounts at the time of admission of a new partner varies considerably. Occasionally, it is not brought into the partnership books at all but is paid by separate checks to the old partners by the newcomer and is treated as a matter of outside the business. 2. In some cases it is recorded as received in the books of the firm but is drawn out immediately in cash by the old partners in their profit-sharing proportions. 3. In other cases, the amount received is entered in the firm's books and is retained in the business as additional capital after the old partners' capital accounts have been duly credited with their legitimate shares. 4. Sometimes the goodwill amount is not brought in cash by the newcomer but a goodwill account is raised and the capital accounts of the old partners are credited with their respective shares. It may be mentioned, however, that it is to the advantage of the newly admitted partner to see that the amount paid by him for goodwill is brought into record in the firm's books. It is equally advantageous to arrange that this amount to be allowed to remain in the firm in proportionate credit to the old partner's capital account so as to leave so much more working capital in the business. But once goodwill is brought into record for a definite purpose, viz., for adjusting the capital accounts of the existing partners before the admission of a new partner, it is not necessary nor it is desirable that goodwill account should be allowed to remain in the firm's books. It can once more be treated as an unrecorded asset and returned back to the capital accounts of the partners. In so writing back the goodwill account, it should be debited to the capital accounts of all the partners including the newcomer in their new profit-sharing proportions, for it will be in these proportions that the partners will share the future profits, including the profit arising from the sale of goodwill. Very often, the incoming partner is not in a position to bring anything in cash for goodwill, and under the circumstance, it becomes desirable to value the goodwill of the firm and record this asset in the firm's books before the admission of the new partner. This is done by debiting goodwill account and crediting the capital account of each of the old partners in the proportion in which they were sharing profits or losses. The goodwill account may then appear as an asset in the firm's balance sheet, year after year, at its original figure. When, however, a goodwill account is raised in the firm's books for any specific purpose, such as admission of a new partner, or death or retirement of a partner, it is not necessary that it should be allowed to stand there for an indefinite period. Usually, on such a purpose being fulfilled, it is written back to the capital accounts of the members of the newly constituted firm in the proportions in which they have agreed to share future profits. In the next lecture we will discuss about the adjustment of accounts on the retirement and death of a partner. Please subscribe and share among the group of your friends for solved problems and lectures on accountancy. Your support is valuable to us. Thank you.